So these investors rushed into the oil market because they needed it not only for the performance that Keynes was forecasting, but they also needed it for this perceived property that it's going to work when everything else is going to fail. So as a result of that, the whole Keynesian backwardation,
Sorry to interrupt. So basically, the whole risk parity concept that you just explained, basically they were hedging, obviously, the interest rate risk with oil futures, right? Is that correct? Just
correct.
Okay.
On a highly leveraged basis.
Okay.
Yes.
Right.
And then what happened that they were so large comparing to, remember at the beginning I said producers bigger than consumers, they pushed the market into structural contango or structural backwardation. What happens after financialization? Financial investors acted like a consumers of oil. They were buying it. So the financial investors started to dominate producers. So investors now were buying more futures than producers needed to sell. That pushed the market into the structural contango. So if you basically repeat that graph that I had a couple of slides ago, this one, for the following 20 years, investors lost all the money that they made. So this is their return from 2005 until roughly 2018. They lost pretty much whatever they made in the previous 20 years. And again, the spot price of oil did not change during time. Your spot return was basically zero. The entire loss came from the market being in the contango. So in the contango, you always buy futures in a higher price than spot, and the futures are rolling down. So you lost it all. Essentially, that would become known as a negative roll yield. So if you think about it conceptually, what negative roll yield is, it's really a compensation to storage holders for holding oil on their behalf. Because if an investor, you cannot buy physical oil, you don't have storage. Your only option as a financial investor, as a risk parity fund, is to buy futures. If you buy futures, you're forced to buy it at a higher price than spot. And that premium to the spot is essentially a payment that somebody else on the other side is going to collect for storing your oil. And that guy on the other side is a storage company, because they would sell you futures at a premium, buy oil cheaper at the spot price, as long as the difference between the two exceeds the cost of storage. It's a free money for them.
And, can I ask you another question, Ilya, because this concept is really interesting. And a lot of retail users would trade oil by buying ETFs or like even commodities, right? But then obviously the risk there is exactly what you're mentioning, which is this.
If you look at USO, somebody can pull up the graph now. If you invest $100 in USO, your life-to-date annual return, I think it's about 94% negative, something like this. Last time I checked, it was around 94%. In other words, if you invested in USO, $100 in 2007, you would have got only $4 left, even though oil prices were basically unchanged. So all of your loss came from the roll. And by the way, even a funnier plot, you can put UNG, which is U.S. natural gas. That one, if you invested $100 into UNG, I think you have about 82 cents left now. So, and again, UNG is extreme. So I think that's probably like the worst investment ever. So, but again, what they don't tell you here, especially on oil, the price of oil has not changed back then. The price of oil is basically still the same. I actually created my own index, called it long short oil, but it's not a subject of that presentation because then I need my own disclosure. But it's on Bloomberg. Some people can take a look.